Good afternoon, this is Todd Colvin coming to you from the floor of the CME Group. We are looking at rates and 10-year note yields. Hold the range again. I kind of feel like a broken record. Over the last 4 Fridays, we've held the weekly range of 280 to 290. And over the last 5 Fridays, we've settled between 280 and 290 in the 10-year yield. So we have really created quite a coiled spring here, so to speak. And the funny thing is that this week, over the last 24 to 48 hours, we've tested both ends of that range more aggressively to the upper end as I speak. We trade around 289. But certainly we have not seen a breakout trade in either direction. We get to those levels, we kind of pause. Buyers come in when we get to 290, we get below 282, we start to see sellers, and it's remarkable how we've held this range without any sort of breakout move, even if it's albeit brief. We haven't seen it. So right now the range holds, and as you can imagine, as the range holds, as expectations remain in play, volatility goes lower, and that trend lower in volatility did continue this week. However, we did see a little bit of a bounce back, a little bounce higher off those lows, given the fact that we saw the yield curve steepen modestly on Friday, given the fact that I think there's some uncertainty over trading, and then there's a lot of uncertainty of what's going to happen geopolitically. That's always out there, but I think a little modest bid heading into the weekend certainly accounted for the fact that the yield curve stopped flattening. It's not necessarily showing a steepening bias, but it stopped flattening, and that's something significant because we don't see that very often when you look at 2s, 10s. And lastly, let's look about what we have next week. Well, next week we have earnings will continue, and the stocks will continue, set the table or the tone for the day when we get those earnings that come out. Yes, we've been seeing earnings that are relatively positive. However, stocks have not been the talk because of the fact that all this trade talk is out there. And otherwise, we also have an ECB meeting next week, and they're not expected to do anything out of the wild blue yonder. However, they may talk about some growth expectations. They may talk about their angle on the trade deals. They may also talk about some of their asset purchases, when they want to maybe pull back the reins, maybe a little sooner, maybe a little later. I think it's still unclear at this point what the ECB can do, not as much as what they want to do, but it's what they can do, and that will have ripple effects here. And lastly, the big number on Friday is going to be advanced second quarter GDP. Now, the GDP now figures, most recent numbers are at 4.5%. And next week we'll get one on Thursday just before the release on Friday of GDP. And this number is expected to be high. I don't think 4.5% is probably a realistic print. However, anything north of 3.5% will be very, very, very interesting to see how the market reacts. And that 290 level aforementioned in 10-year yields is probably at risk if we do see that 290, or we do see that 3.5 or higher percent mark. So right now we're going to focus on earnings. We'll focus on the ECB meeting. We're going to focus on GDP, and then in the background you're going to hear noise, trade tariffs on China. We're going to trade talks with EU. Anything political that's going to go around is going to continue to kind of be a wet blanket over the market. And I think that as the market absorbs a lot of the information, whether it's fact or whether it's just you're hearing it on social media or whatever, things will normalize. And I think that the more trade talk we get, the more the market becomes numb to it. We kind of got that this week with the 500 billion or 200 billion in tariffs being announced on China, and the market, it traded, but everything kind of came back to zero at the end of the week. So we didn't really see a sustained trade based off those rumors and hearsay. So right now, 10-year notes still in that range, leaning towards breaking out to the upside. So that means lower prices, higher yields, but a lot can change next week. This is Todd Colvin coming to you from the floor of the CME Group.